Supermicro filed a Form 8-K disclosing that George Cao, Senior Vice President of Operations, will retire effective December 31st, 2025, and that Tom Xiao, Senior Corporate Vice President of Engineering, will assume Cao's responsibilities. The company said it doesn't expect the move to disrupt operations and that Cao will stay on as a consultant to help with the handover. Supermicro also said it will disclose the consulting terms in an amended filing. Why does that matter? Operations is literally the heartbeat of a server maker. Procurement, assembly, test, quality control, and shipping. When you're building liquid-cooled, GPU-dense servers for AI data centers, timing is everything. A hiccup in operations can delay a multi-million-dollar shipment. That makes a change in the operations lead worth watching even if the company says no disruption expected. The market reaction, a little wobble, not a collapse. After the filing, Supermicro shares closed down modestly, about 1.4% on the day in some reports. The move happened in a holiday-thin session. Trading volumes were light overall, and the major indexes were slightly lower, a setting where small news can look louder than it is. Nationwide's Mark Hackett described the market action as a healthy rebalancing of allocations, which is a polite way of saying people shuffled portfolios into year-end. Translation: this wasn't a panic dump, it was a polite eyebrow raise. Traders care because the quarter ends December 31st, and the company has to show whether production and shipping went to plan. With AI server customers demanding on-time delivery, any risk to execution is top of mind. Why the timing is extra sensitive: quarter end and deliveries. Supermicro's quarter ended December 31st. For hardware companies shipping big, rack-scale AI systems, quarter end is when management either clocks revenue or admits it slipped to the next period. Traders will be watching for A. the amended Form 8-K that discloses the consulting terms for George Cao, and B. the next quarterly update to see whether promised shipments actually left the factory. That's because Supermicro's customers, cloud providers, and hyperscalers schedule large, tightly engineered deliveries that require exact testing and validation windows. If one delivery slips, it can cascade across the quarter. Imagine you build a wedding cake for a banquet hall. If the oven runs late, the cake doesn't ship, and the wedding planner gets mad. Same idea, but with racks of GPUs and millions of dollars at stake. The filing details: consultation, amended filing, and what to watch. Supermicro said Cao will remain as a consultant to help transition responsibilities, and that the company will disclose consulting terms in an amended filing. Investors watch consulting deals closely because the terms matter. Duration, compensation, and scope tell you whether the departure is tidy, short handover, limited fees, or a protracted dependency. Long consultant term, high pay, that could signal deeper management instability. The company's assurance of no expected disruption is standard language, but traders will want to see the details and then watch whether shipments and order fulfillment in the December quarter back up that claim. If the amended filing shows a long consultancy or expensive severance, that could ruffle feathers. If it's short and cheap, probably a non-event. By the way, if you are benefiting from the content so far and want more like this, like the video, it means much to me, or hit the subscribe button and comment the word more. Just go ahead and type the word more so I know. Now that you have commented, let's continue. Execution matters more than optics for a server maker. Supermicro isn't a software startup you can reboot and patch. It's a global assembly and test machine for high-end servers. That means operations involve long supply chains, component lead times, thermal engineering, and wafer-level logistics. When deadlines slip, the result is not refresh and try again. It's delayed customer rollouts and missed revenue recognition. That's why investors track operations leadership closely. If a hyperscaler wants 100 racks of liquid-cooled servers by January 10th and Supermicro can only ship 60, the customer may push some spin to a competitor. That's real money and real market share risk. Broader context: a rocky 2025 and lingering governance questions. This operational news arrives against a tougher backdrop for Supermicro. The company has previously faced delisting concerns, changed auditors, e.g., Ernst & Young resigned and BDO/others got involved, and has had adverse opinions or flagged internal controls over financial reporting in public filings. Those are not little bookkeeping frowns. They are governance issues that make investors nervous about transparency and reporting accuracy. The recent period saw regulatory and auditor scrutiny and a public debate about financial controls. Why that matters? Investors price not only the business but the certainty of its numbers. If you can't trust the reporting, you demand a discount. That explains part of why SMCI shares are well off earlier highs. The stock's performance this year, underperforming the market. Supermicro's stock has underperformed the S&P 500 in 2025. Headlines show its shares were down over 70% from early 2024 highs by late 2025. The company was one of the worst performers in some months. That's a consequence of the combination of execution uncertainty, delayed filings, auditor issues, and swings in AI server sentiment. Barron's and other outlets summarized how a wild rally earlier in the year was followed by governance-led pain. The business is cyclical and highly levered to AI server spending, so price swings have been extreme. Good quarters produced big pops. Bad news produced painful drops. What analysts are saying: competition, commoditization, and margin pressure. Some big firms have turned cautious. Goldman Sachs and other brokerages warned that stiff competition and commoditization in the AI server market could pressure margins and make life harder for Supermicro. Larger enterprise OEMs and system integrators, with broader service portfolios, can make price and service plays that squeeze smaller specialist margins. That's a strategic risk. When the industry standardizes around commodity rack designs, differentiation and high margins get tougher. Put differently, if everybody starts building the same rack with the same GPUs and the same interconnect, the conversation shifts to price and service, not engineering wizardry, and that hurts makers who need premium margins. Note this as well. Do you want peace at heart? The next day John seeth Jesus coming unto him, and saith, Behold the Lamb of God, which taketh away the sin of the world. John 1:29. Fear God, and give glory to him, for the hour of his judgment is come, and worship him that made heaven, and earth, and the sea, and the fountains of waters. Revelation 14 verse 7. I appeal to you to fear God, and obey his law. For his commandments are sure, and his word everlasting. Do not be afraid. Do not be discouraged. Want more information? Please check the description section. That's the end for now. If you have watched until the end, drop a comment like this: I stayed until the end. Just comment that I stayed until the end. When I see this comment, I will give you a heart. 3 more favors I request from you. First, like this video, subscribe, and then turn on the notifications bell. If you do this, you greatly encourage me to continue bringing to you insightful information. Do not miss out on our future videos full of insight. All I am asking is your subscription. Thanks for joining us today. Your support means so much to us. Do not hesitate to share this video to help someone who may benefit. I recommend that you watch the next video, subscribe to the channel, and share your thoughts about today's video. Wish you God's blessings and care. Wait, watch and pray. See you in the next video according to God's will.